But I think what's interesting about the question about finance and growth is that this is, at least this is my impression, it's one of the few, maybe one of the few questions in economics where we have a quite clear answer from the academic literature. So in the last 20, 25 years, I think there's been a huge development in the number of papers and academic output more generally that has been produced. I think by and large, people do now believe that if countries see an expansion in their financial system, they tend to also experience higher growth, and there tends to be a causal relationship between these two developments. So I think this for a long time was the big question. Do we see more finance actually just being associated with more growth, or do we actually see that more finance is actually causing more growth? And that discussion goes back actually to Adam Smith, who basically, there's a very nice passage in The Wealth of Nations where he shows that, or where he mentions that when the first banks were established in Scotland, there was an increase in trade and in economic growth. And he basically mentions that it cannot be doubted that this is the one development is actually causing the other, so that the banks are actually contributing to that economic growth. But then for a couple of hundred years, people actually have been very heavily debating whether this is the case and whether these things are actually more loosely associated, or maybe it's the case that when growth happens, it's actually banks and other financial intermediaries that follow, and so the causation runs in the other direction. I think what we've seen, again, starting in the 1990s and also more recently, is a huge output of research, starting with very simple growth regressions, cross-country growth regressions, and later on using much more detailed data sets to quite convincingly show that if financial systems develop, there's actually a causal impact on economic growth. And that has been shown at the country level, as I mentioned. It has been shown at the industry level, and increasingly people are using very detailed micro data sets at the household level or at the firm level to show that once households or firms actually do get access to external finance, they subsequently tend to start to grow. I think so. That's overall a very positive message, and a very clear message in the sense that a lot of people now agree that finance can be a potentially force for good. I think what we've also seen in more recent research is that that doesn't mean that more finance is always leads to more growth, and that there's this sort of a linear relationship. In particular, after the global financial crisis, we've seen that there may be something like too much finance, and what we've seen is really a huge output of recent research showing that when financial systems, and in particular banking sectors, become too large, there may actually be risks involved. And there are various types of risks. One of them being that too much finance gets allocated to low productivity or even projects with negative productivity characteristics, and that is leading to more fragility in economies. More generally, there is a shift towards mortgage lending and consumer finance, which may beneficial, maybe up to a point be beneficial, but they have much less positive growth impacts in the longer term, so they're not really contributing to productive capacity of economies. And we also see that if a financial sector becomes way too large, it starts to suck up a lot of productive capacity from other parts of the economy. So a lot of bright students, for instance, may decide to go into the financial sector rather than go into the real sector and start to invent new products that may be potentially more useful than another financial innovation. So you can get these lopsided financial systems that actually at some point start to no longer contribute to growth. I think that's a message that we also need to keep in mind. There are also a lot of questions that are not yet answered. I think one very important one is the question, if banks become larger, if they start to lend more, what are the type of firms that actually should have most access to credit? Where do we see that the impact of credit is actually the largest? Should we be lending a lot to micro borrowers, to sort of very smallest of firms? Should we perhaps focus on small and medium-sized enterprises? Or should we go for economies of scale and lend to the largest firms in an economy, and in that way we actually maximize this beneficial impact of finance? And I think there the literature is much less in agreement, and the data are also much less clear. In fact, there's one, and I want to show you. I'm actually going to show you two slides today. This is the, hopefully this works, this is the first one. There's actually quite a bit of research on microcredit and the impact of microcredit. One reason for this being that it's a part of the financial system that has expanded very rapidly, that has also absorbed a lot of donor funding, and so of course donors want to know whether the money that they spend is going to be used wisely. And also the claims surrounding microcredit have been quite extensive. So I think proponents of the microcredit industry have argued that access to microcredit can actually be really transformative in the way it changes societies, in the way it changes economies. The other reason why there's quite a bit of research now on the impact of microcredit is that if you want to very rigorously measure whether microcredit works or any other type of financial services, you would ideally like to do that in an experimental setting. And since these are small loans, they lend themselves quite well to experiment and to see whether the random introduction of microcredit in some areas but not in others is actually having a difference on the people that start to borrow. Now, the picture that I'm showing you here is sort of a summary slide that explains one of the aspects that a lot of microcredit programs look at, which is business ownership. And this was mentioned in the keynote just before, that there is this idea that everybody is an entrepreneur, and there's this unlimited power of entrepreneurship. And if we only unleash that, then people will start to become entrepreneurial and they can work themselves out of poverty. And that's one of the claims that is often made when we talk about microcredit. So what researchers have done in a number of settings, and I'm showing you 6 countries here. There's a 7th one, Mexico, which didn't fit the slide, so I've left that one off. But the picture is very, very similar. What researchers have done is basically see what happens when we actually test that assertion. If we're going to randomly introduce microcredit in certain villages, but not in other villages. Or as a study where I was involved in myself in Bosnia, if we take a group of people, so what we did is we took 1,200 people that were interested in borrowing from a microcredit institution, and half of that group, a random half of that group, we gave access to microcredit, and the other half we denied a loan. And then we follow those people over a couple of years and see what happened to their lives. Is it really the case that when you introduce microcredit, that these people do become more entrepreneurial and they work themselves out of poverty? And what this slide is basically showing is that the evidence is not that strong. There are very small differences on average between people that do get access to credit and people that do not get access to microcredit. So I think we have to temper the enthusiasm for microcredit just a little bit. I don't think it's the case that when you give access to credit to people, if you only give access to credit, that they suddenly become very entrepreneurial and they start to set up these very productive enterprises that can then grow and help themselves and other people out of poverty. At least in the context that we've looked at here, and these are, as you can see, countries pretty much across the world, we don't find strong evidence that this is the case. Now, what we also find, and I'm not showing you that here, but I think it's important to keep in mind, is that there are other impacts of access to microcredit that are quite beneficial, right? So we do see that these people actually make changes in their lives. They become less sensitive to economic shocks. They're actually able to earn money in a different way, so they start to work more in enterprises that they already had, and they start to work less for other people, so they can switch out of labor, traditional labor relationships, if you will, into self-employment. And I think that in itself is a positive thing. So you can see that people have more ownership of the way they earn their money and the way they are managing their economic lives. And I think that's something that is very important for large parts of the population in emerging markets. But we do not see on average that people actually become entrepreneurial in the sense that they set up new enterprises. There are small groups of people where we do find that effect, and I think this is one of the challenges for the microfinance sector going forward, to actually identify those small number of people. So on average in these data sets, we've seen that about 10 to 20% of the people actually do set up new enterprises compared to these control groups, and they are relatively successful. So I think there's also a story here where microfinance institutions need to be much better at targeting the right type of people, perhaps giving them larger loans so they can really scale up these business ideas, while at the same time they should give probably smaller loans to those people that actually do not have that great entrepreneurial idea, but maybe using microcredit for other purposes, either to buy a consumption good or perhaps to have a bit more financial flexibility in their day-to-day lives. So I think it's time to change that narrative about microcredit just a little bit. I'm conscious of time. Let me show you one more slide because I was asked to talk about the gap, the existing gap currently between the emerging markets and developing countries and rich countries. Now, I think this is an interesting slide to look at. Again, we are moving here from microcredit to a very macro picture. But this is basically credit to non-financial corporations, firms basically, as a percent of GDP. And I'm comparing here the developed quote-unquote countries with emerging markets and developing countries. So one thing I think that we should keep in mind is that in the past 10 years, so the 10 years that have now passed since the global financial crisis, which is the time period that I'm showing you here, there has been a tremendous increase in indebtedness in emerging markets. Okay, and a couple of years ago, basically emerging markets as a whole have really overtaken the developed world, again, quote unquote, in terms of the amount of debt that is outstanding. On my way in the tube here, I was reading an IMF press statement, I think of today, of yesterday, where they actually point to this as one of the main sources of vulnerability in the global economy at the moment. So when we talk about gaps, let's keep in mind that on average, there's a lot of debt in the private sector in emerging markets at the moment. There are a lot of over-indebtedness problems, and there's a lot of risk out there, in particular in those countries where firms have really leveraged themselves up with foreign currency denominated debt. And if we talk about financial inclusion, if we talk about extending financial services to the emerging markets across the world, I think it's very important to keep in mind that we should really focus, again, we should be really targeting those people that are currently excluded, because on average, there is already a lot of debt out there in that part of the world. So let me stop here, and then we can talk a bit further later on.
My presentation is based on the assumption that financial development leads to economic development. I'm also going to try and present to you today a very practical side of things. We have a lot of people from academia here today. As Claudia mentioned, I've done a little bit of that myself, but I think I can bring a little bit more value if I talk to what we find day to day as a commercial bank, as one of the largest financial institutions in Africa, Barclays Africa Group, and the challenges that we face. So I'll try to bring that angle to spice a little bit the discussion. The first thing I would like to also bring in terms of context is, especially when you work in a region like Africa, in a continent like Africa, you'll find that the typical aggregates in macroeconomics don't really work. So GDP growth, for instance, that is what you read the most in newspapers or in the media, of course also in academic research. It's a nominal account. So you would first try and look into, for instance, GDP growth per capita, but you still face issues as measuring like that. But just with that change, I can give you the example of Mozambique, where I come from. GDP growth in Mozambique last year, 2017, preliminary figures, 3.7%. Now, we're also looking at the very recent census that was produced for the last 10 years, where the conclusion seems to be, we're still waiting for the final numbers, but on average, each year population growth, 2%. So you immediately see that the GDP growth per capita, or the GDP per capita growth, it's actually less than half of what would be the pure GDP growth figure. And if you add to that the fact that in some of the developed world, the population is actually shrinking, which would boost slightly GDP per capita growth vis-a-vis the pure GDP growth, then you'll find out that comparing these two realities become something completely different, and they may be much closer to each other than normally you would say. So that's something I think it's important for us to bear in mind. But when we get to developing economies, what's really important is to get out of the aggregates and get into the detail. And particularly, although very difficult because of lack of data, looking at median rather than average indicators. So median household income, for instance, where you can take out the average to bring in the inequalities and the asymmetries that you find in the economy. And that's what we find every day on the ground, is about how difficult it is to separate and analyze the market between these two different worlds, typically sitting in two different extremes. But let me try and then address three big topics. First one, institutions, financial institutions, and how they are currently operating. I'll try and keep it in the perspective of a pure commercial bank. I won't go into much of the extremes in the financial services area. But first of all, intermediation. Clearly, and I guess Rolf also alluded to that, there is a significant impact from banking system development into a certain economy. There's no doubt about that. I guess what we need to take in consideration are the limitations that currently developing countries face compared to what we know from developed countries in making that being an even greater impact. We do bring forward the potential income of the future. As we've seen in our own world on the North Hemisphere, as I like to call it, there was a generation that bought a house before they actually worked to pay it. We're still very much in an incipient stage in Africa to be able to do that. If I give you some numbers, you'll start understanding how things work. In Mozambique, you probably get 10 home loans per week in the whole country, okay? These are staggering numbers. I mean, any small branch in the rural area in the UK will try and do more. Their sales targets, for instance, certainly say more. So we are talking about completely different reality, and that's why also you'll find that the financial system is not able to completely be an engine as you would otherwise expect. Access to banking is also an important aspect. Most of the countries in sub-Saharan Africa would report today a percentage of about 20% of adult population that has access to a bank account, that holds a bank account. So that, again, compares to statistics in the developed world that tend to be north of 90%. So if you don't have access, then obviously the financial system is not able to help you. And I'll talk a little bit about how that's been overcome very fast indeed in recent years. Another important element here is financial literacy. Education, and we are in the house of knowledge, education is, I would say, #1 priority for any sector of activity you may be in a developing country. It doesn't matter if you're in banking, it doesn't matter if you're in agriculture, it doesn't matter if you're in oil and gas, as many countries are, or in the whole commodity space in Africa. Education is crucial. So the fact that most people don't have the ability to understand the financial contracting that comes with a developed financial system limits a lot how much the established financial system can actually help the economic development. And indeed, its own growth, of course. I'll give you another couple of examples that I think are quite interesting. Most banks in Africa, again, sub-Saharan Africa, I probably want to make clear that typically I would refer to sub-Saharan Africa. They actually help people, and they even issuers in some cases, of tax numbers, individual tax numbers, because otherwise people wouldn't get one. They facilitate for people to get an ID. A lot of our customers open a bank account at the age of 30, and that's when they finally have an ID card. They never had one, they never needed. I don't know the statistics on passports, but I can tell it's probably like single figure percentage of the whole population holds a passport. People don't travel beyond borders. So the fact that the access, the literacy, the development of the society in general is at that stage, of course, that limits a lot how financial institutions can then help. But they're doing their job, especially with examples like what I just gave you, where they promote that social inclusion that, of course, then leads into financial inclusion. And then I think still in this front, the investment in human capital. Most countries you may visit in that part of the world, you will find that the average quality of human resources sit in financial services. it happens so because there's a lot of investment in training, in education internally in organizations. But there's also the benefit of not only having a financial system that can help promoting financial inclusion, but also inevitably then these people will move into other sectors of the economy, and there's, I think, a multiplier effect there. It's something that you probably wouldn't see so relevant in other parts of the world, but I can tell you that if you're establishing your own business in, let's say, Malawi tomorrow, you will probably gonna start looking at the resources that the banks have to try and get one or two to come and work for you. So there is an economic impact there too. I could talk about regulation, but I won't touch it too much. I would just say regulation in developing countries is typically as much of a constraint, although we must accept that for very good reasons, but there is certainly constraint in terms of how much the gearing of the economy can be led by financial systems because of regulations. Looking into instruments, financial instruments, products and services. First of all, there's no much sophistication. So it's not the same as, again, walking into a branch in the UK, or if you're a corporate, calling your account manager and discussing a very complex hedging strategy. But one must also think about what's the need, and typically the need is not the same. First, in retail, as I said, with the literacy levels that we find, you typically won't be able to push anything that is very sophisticated. But secondly, then, you have issues with markets, and I'll talk about markets in a minute. But even if you have a multinational, let's say Nestlé lending into, let's say Namibia, there will be a limitation in how that local market can offer financial instruments to Nestlé. So the sophistication on the bank side and on the client side may be there, but then the market itself also limits, and I'll talk to it in a bit. But I'll give you, again, a couple of examples that I think may be useful. One of them is equity release. So equity release, I'm assuming you would easily understand the concept, talks to a home loan, a mortgage, but that is provided to the existing owner of a property, not a prospective owner. So you basically provide a mortgage on your own assets that already exists. Now, that's a relatively residual product or financial instrument in other parts of the world, but I can tell you it's making a big difference where I come from. Why? Because a lot of people have access to property for historical reasons, but their household income is quite low. So they're not able to maintain their property. With finance coming in and providing the ability to raise funds against that property, they're actually able now to refurbish the property. Often we see, if it's a central location, a premium location, they may even leave the house to move in the suburbs and eventually rent it out to someone from the United Nations who's going to pay $5,000 a month. So there's an opportunity for helping some segments of the society that otherwise wouldn't, with some products that are quite basic and sometimes even neglected elsewhere and become quite relevant in these economies. But the constraints are also there, and I'll say, for instance, debt to coverage ratio, or let's say the criteria to lend in these cases are typically very low, very conservative. Why? Because collections are very difficult. Because there's no addresses, for instance, in most countries in Africa, okay? Because people are much more mobile than elsewhere, because the judicial system doesn't work the same way. So the cost of operating is much higher, which means you need to be more conservative, and also, of course, explains credit spreads and other market statistics. The other thing that I wanted to note when referring to products, or let's say instruments, it's the recent surge in impact investing. We have received a lot of queries from large family offices, mid-sized asset managers, and other people from the developed world, wealth managers, about opportunities to invest with impact, opportunities to invest in a socially responsible manner. And that's something that I anticipate is going to happen much faster going forward. We can see a lot of opportunities for sure, mainly in agriculture because of the impact it has in the population. A lot of the large multinationals currently operating in Africa tend to employ on average something like 5,000 to 6,000 people. On the peak of the production, because they have a lot of temporary workers, it may go into 10,000 people. If you think then on average a family in that part of the world as something like 7 to 8 people, then you start talking about big numbers. And some of these investment is looking at how many people can I impact with the money I'm putting in, and how much is their household income growing by. So sometimes you can talk about 50%, 60% increase on a very low base. So something also to bear in mind. And then finally, about markets, I've gave some hints already, but let me just say, money markets, FX markets, capital markets, very much in an incipient stage. So a lot of constraints from both the size of the economy, for instance. So if you have a relatively small economy, you know that the capital market is directly correlated to that. So you won't have many listed companies, or the size and the market capitalization of those will be limited. But most importantly, across all of these different markets is the depth of the markets. There's no liquidity available. So even between banks to buy currency, for instance, sometimes we struggle to find a counterparty to sell. So the liquidity in trading currency, in trading bonds or equities is typically very, very low. So there's a lot of opportunities to grow there, but at this stage, this is certainly an area where there's not so much of a boost coming from financial services or the financial industry into the economic development. I would certainly exclude a couple of countries here. South Africa is typically out of any of the comments I've made. Nigeria, there's some activity in Mauritius, Botswana, but generically speaking, that's unfortunately not the case. And now, just to finalize, I'd like to bring a bridge between what I said and technology, and maybe to then lead into the discussion. Because the way we see it, technology is the key to unlock this level of stagnation. We've seen technology and mobile money in particular having much more impact in Africa, for instance, than in any other part of the world. So people really adhere to it. We have technology being the leapfrog of the continent. People in Africa mainly, or most of them, didn't have a landline. Almost everyone has a cell phone today. And by access to that technology, which is quite well spread, then you can bring in mobile money, as we've seen in many countries, and I guess more and more being so critical. But I'll probably stop there, and I'll just note 2 or 3 things from what I said. One is the growth will come from addressing the needs. And I think it talks to what Professor mentioned. It's not about making money, but it is about addressing a problem. Productivity makes the whole lot of difference. And the gearing that the financial system can be allowed to. Thank you very much.
Thank you so much. Thanks a lot to Ralph and Rui. So the plan was to have some questions. I'll probably just have one question from the audience, and then we'll just go outside, and then you can also have the chance to talk to our guests. So one question from the audience. A question. Okay, I'll get to ask my question then. So the question I had for both of you is, how do you see the new technologies? I know Ralph has some experience, for instance, on blockchain and how this can have an impact on these developing economies. How do you see it in terms of as an opportunity and as a challenge, Ralph?
So I think one thing to keep in mind, so the mobile phone example was given. I think that's very interesting. We know that has taken off immensely in Africa in particular. I think the interesting aspect of that technology is that it's doing much more. It has a much broader impact than what people maybe initially thought. So of course we know that mobile phones are being used to some extent to save, but in particular to make payments, and that has facilitated payments and trade within countries to a large extent. But we also see that it has, and again this is based on some recent research, that people are really using this as an insurance mechanism as well. So the fact that you now have a mobile phone, you can transmit money within the country with relatives and friends that are not just living in your village, but they may be in the capital city or in a larger city, or they may even be abroad, and they may be willing to remit money to you. That is having a huge impact on people's lives. So I think it's interesting to see that a mobile phone can almost become like an insurance product, in the sense that if there is a negative shock to you or to your household, you can actually collect money from a much broader range of people than was initially possible. Maybe one other comment is that it's not a solution to everything. There are important complementarities between new technologies and old-fashioned infrastructure. So there's a lot of, again, research showing that people can use their mobile phones to actually to discover what are the best prices for their products. Right? So there are a couple of papers that show that fishermen that actually have caught a bunch of fish, they can actually use their mobile phone to now check in which port actually the price for fish is highest, and depending on that they can actually make a decision on where they can get the best price. And so people get very excited about that, and rightly so. I think that you really see how this technology is making markets much more efficient. But we also know that for other similar impacts, we also need old-fashioned infrastructure. So, for instance, if it may be very useful for you to know by calling a bunch of people where the highest price for your product is, in what city or what part of the country you can get the highest price. But if the infrastructure is crumbling, if you can't travel there, then that information is not much use. So I think there are these important complementarities between old technology or old infrastructure and new technologies. And you mentioned blockchain. I think this is very exciting, in particular in countries where centralized solutions to information problems are not available. We're working in Jordan on a project where the central bank has only just set up a credit registry. I mentioned earlier on that in some countries there is a problem of over-indebtedness. So both households and firms are borrowing too much. And one of the reasons why this is happening is that they get loans from several providers, and these providers are giving these loans because they don't have the full picture of the total indebtedness of these borrowers. So one very straightforward solution to that is to have a credit registry, a central credit registry that actually keeps track of all the loans of all the firms and all the households in the country, so banks know that if a borrower comes to them, whether that borrower has already outstanding debt elsewhere and whether there's a risk of over-indebtedness. Now that works well for the largest parts of the population. In Jordan, currently a large part of the population is actually not Jordanian, but is Syrian. So there's a huge refugee population that are not served by that central credit registry. And so a decentralized solution, and blockchain is one technology that you can use for that, can potentially be complementary to those centralized solutions. So what we're trying to see is whether we can help people to build a digital identity, if you will, where they can use blockchain, a blockchain-enabled app on their phone to build up a credit history over time, and whether that is going to help them to get access to credit from Jordanian banks and microfinance institutions, but potentially also may help them if they go back to Syria or if they move on to another country. So the idea, of course, of these decentralized solutions is that it's portable, and it's portable across borders. So if they would go back to Syria at some point in time, we would expect that at least some of the Syrian banks and MFIs may then actually use that information that is encrypted in these digital lockers, if you will, to decide which borrowers are creditworthy and which ones aren't.
Okay, thank you. Rui, maybe you can briefly comment on this, and then we can just go for the coffee break.
I'll just share two thoughts. One, and I mentioned it, is productivity. Technology is crucial to achieve productivity, efficiency levels within the organization, but also greater productivity in human resources. And because of the gap we find between developing countries and developed countries, bringing these tools into those accelerates closing that gap. And I think it's really important to understand there's nothing happening out there in Mozambique or in the region that is not available in the UK or the US. But the impact it has there is much, much greater than the one it has here. I think that's really a critical element. And maybe just to kind of cross with what Ralph has just said, we have a number of markets where we have credit bureaus, but still the quality and extent of the data that is available is not so good. We have partnered with a startup company, a fintech in Cape Town, where we have an accelerator, an incubator for the group. And we're already running credit scoring on the basis of your social networking activity. So public data available through your profiles in Facebook and the likes. So that's heading to the kind of information we have through traditional means and hopefully increasing the quality of the decision, lowering the price, and enlarging the basis of to whom you can lend. So technology is not different elsewhere than it may be here, but the impact is much, much greater because of the gap that exists, probably say that.
Okay. Thank you so much, everyone, for the discussion. I think it was a great discussion. So we can now go for the coffee break and certainly continue to talk about this. Thank you so much.